coming in chapter 9, which is in the book, our book for Long at All 2015. And actually, I have recorded this into 2 parts, but this is the part 1 recording. And the slides, only one slide, which has one file, PowerPoint, which has been uploaded for you. So if we come here, we are talking actually in week 7 and 8, if this is the balance sheet of the bank, we are talking about this area, which is the investment. Now, the investment can be either long-term investment or can be short-term investments. And this classification is very important when we talk about market risk, because we have here something called banking book and trading book. Now, the banking book is those type of investments that we will hold for a long time, and they are actually considered to be illiquid. But the short time is the trading book. And now the trading book is actually dealing with what we call long position and short position. This is basically buying and selling financial securities and getting profit out of that. Now, managing that is a very difficult thing and include too much risk, especially when it comes to derivatives. So many banks have been collapsed because of the tradings in the derivative side. Now, just to give you some information about what is the long position and short positions. So long position, I think you are familiar with. I just buy the assets. When the price is down, wait for some time. When the prices goes up, and sell it or keep following the price. The short position is actually different. When we know that the prices now is high and they're going to go down, so it's better we borrow from someone else and buy it now, and sell the assets that given to us by someone else, and they will tell you who is this someone else, and then buy them later on and give it to and cover your liabilities. Now, who is doing this? Actually, huge bank like Goldman Sachs, like all those type banks who are working as brokers. They provide huge what we call positions for their clients. If they are interested actually to borrow, they provide them with some type of stocks and bonds and commodities, and they can sell them now, and later on they buy them and give it back to their broker. So this we call the short position. The long position is a normal thing. We just buy the assets, wait for some time and sell it. Now, this applies to the fixed income securities like the bonds. It also applies to commodities like oil, steel, rice, all those type of commodities, which European banks are very active in it, and the international banks are very active in selling and buying this, type of assets. And then, of course, the operations of the currencies, which is the foreign exchange, trading those currencies and getting, profit out of the changes in the interest and the exchange rate. And of course, the equities, which is buying the stocks of corporations. And now we have also derivatives, which is huge business. Now, the derivatives, you can talk as a bank. You can talk about, what we call speculations. You just buy without involving in the price. And we will talk about this next week. We are not going to include we don't hedge, but actually we gamble or speculate on some type of prices, and then we go to those derivative contracts, either in long positions or short positions, and then get profit of that. This is a very risky one, whether you are going like, provide selling and buying in the same time, which means sell to people and buy from people, or when you go and do just one single and, transaction, like when you speculate in some prices. Now, having said that, let me just show you which one is so here is as I told you, the short positions, and this is the definition, and this is the long positions. Now, when we come to market risk, we remember this man, which is Dennis Witherspoon. He was the before this current Jimmy Dimon of JP Morgan now, who is the chair. This one was before him, and he's the one who provided something called risk matrix. What is, and which is actually the subject of week 9. What is the issue of risk matrix? These guys say, okay, JP Morgan is one of the big banks and we have all this trading. He was talking about the trading book. And therefore, instead of this trading is very risky and it happens on a daily basis. And we don't want to wait a long time before we know how we are doing in this and see our exposure. I want it to be in daily basis, which means I need all my holding in the trading book in terms of risk to be measured daily and to be reported. And this is where they follow the risk matrix. Now, just to come back to what we are going to talk about today, we will introduce this market risk. We will talk about its measurement. And we will, when we talk about the measurements, we have 3 measurements, the risk matrix model. And we have another model because this has some weaknesses. They provide what we call historic or back simulation approach. And as you can see, it's already simulation. And then this also has another problem and weaknesses. Then they provide the Monte Carlo simulations. This is what we see in the industry. The regulators also have their take. So BIS, which is the Bank of International Settlement, provides something called the standardized framework to measure under the regulatory model to measure what we call market risk. And then they provide another model used called the internal models, which is actually advanced from this model. Now we will talk about this a little bit, but actually we are not covering it because we are going to talk, when we talk about regulatory models, the regulators are concerned about whether your exposures in the market risk actually will be covered by your capital. And therefore, this is part of the calculation of the capital adequacy, which will come in week 11. But now we are talking from the private perspective, which is this blue font. Now, why market risk comes to the picture? Let's ask ourselves this question. Actually, when you are holding, either you are talking about derivatives or commodities or foreign exchange or equities or bonds, and actually this is affected by the movement in the market. And what is the movement in the market? Mainly the interest rate risk, the interest rate and the foreign exchange. So the interest rate risk and the foreign exchange risk, actually those movements actually, they overlap and they impact our holdings of the assets. And what they do, they increase or decrease the prices. Of course, we were worried about and our concern and the risk when the prices will decrease because of the changes in the interest rate in the market or the foreign exchange base. And when we measure it, we can measure it in monthly time, quarterly time, annual near-based time, semi-annual time, or we can do it as JP Morgan did in 1 day. And when we do it, our reports about the market risk, we don't bring it in percentages, but we say this is, if we have a portfolio of 1 billion ringgit, for example, and some type of market or assets, and we say, okay, then our losses in 1 day is maybe 100 million, something like this. So actually it is measured in dollar value, not in percentages. As we know, the market risk is coming because we are trading, and if we are trading, we are exposed to risks. Now, as I said, the measurement of the market risk comes in dollars, and we have to provide a control mechanism for market risk, including the employees' credit risk, created risk. Now, somebody would say, what is the employees? Employees actually are the traders. And we have seen so many banks collapse because of these mistakes of the employees, which we call them the traders later on, especially when it comes to derivatives. They take huge positions in the derivatives. And we saw JP Morgan lost around $2 billion in 2013. We saw Berenbank collapse because of this trading in Singapore. And we see all those issues, and those were single people who are actually, they are employees, they are managers actually doing or controlling that trading book for derivatives, which is part of the market risk. And we want also to talk about the hedging mechanism, and of course they use different hedging mechanism when they trade. Now, why it is important to study market risk? Of course, we need management information, but we have also to set risk limits. For example, when we see, we can shift, our portfolio based on the risk, and we can also decide when we sell and when we buy. So if you are actually having good market information and you know the risk exactly, now in this case, take for example some type of stocks. If the prices always goes up and down, and we have enough information, when that zigzagging happens, you go to the peak, this is the time, if you are holding, if you are going long, this is the time when you sell. And when the zigzag goes down, and the curve goes down, down until the bottom point, that is the time to buy. If you are going long, this is the time actually to buy. So then the price will go up. So this is when we say setting risk limits. Actually, also we need it for research allocation. So if the bank, as I told you, is allocating 1 billion ringgit for $1 billion, for example, in trading for some type of markets or some type of assets, for example, in equities. Now I have to choose which one of those equities, or maybe for currencies. I want to see which pair of currencies I should be trading on. That created that exchange rate risks. So when you do that, you will know how to use this 1 billion ringgit in the best return that can be generated from those assets. So the research allocation is actually allocating the 1 billion ringgit in the best asset that will give you the highest return. Now, it's also important for performance evaluation. And somebody would say, what performance evaluation? When you could talk about market risk and trading, you have employees, which we call them traders. Now, those traders, some of them will, for example, trade in government securities, and they will be specialized in this. Some of them will do derivatives. So that guy who works in, for example, government securities, their risk is a little bit, and their return is a little bit. If they don't make losses, especially when we talk about defaulting losses, but somebody who's working in derivatives will go up and down. So in this case, when you come and you want to evaluate the performance of those two traders, you have to take this market information, and you have to have enough market information about the assets they are trading and the nature of the risk and the return which they are involved in. Finally, we need this information for the regulation. And regulation is very important, as I told you, and regulators use it to see how much risk you are taking. This is one issue, and whether you are complying with the standards, and they want to check your exposure. And one more important thing, to measure whether your involvement in this trading, and in case you encounter any risk, whether your capital will be enough to buffer that risk. So actually, when we talk about market risk, it's part of the calculation of the capital adequacy, which we will take it in week 11. They have so many risks. Market risk is part of it. So when you provide information about this, you can show whether the risk that will come from the trading, or the market risk, is actually can be buffered by your capital. Now, in terms of the exposure, we have the risk matrix, historic or back simulation. These are the three methods which we'll talk about it. And maybe this map will give us enough information about what we are talking about. So actually, we developed something called the DEER. And this DEER actually is the daily earning at risk. And it assumes yield chains are normally distributed. It has some, assumptions. And when we calculate the DIR, actually, we calculate the risk of 1 day for all of our assets. So the DIR started with calculating the market exposures over the next 24 hours. And the way we do it, we get the price volatility. And the price volatility, which is the changing in the price. We take the modified duration and multiply it by the potential adverse change in the yield. And I will show you how we will do it in the curve. So we have to calculate this item and this item to get the price volatility. Then multiply the price volatility by our holdings. So if we have a portfolio of 1 billion ringgit, of $1 billion, and the price volatility of the assets inside, say 2% or 3%, we can transfer that amount into dollars. And we can say, well, our DIR, which is the daily earning at risk, is that amount. And we'll show you how much the maximum we can lose from our portfolio. Now, when we do that, we don't do it for one asset, but we do it actually for each asset, and then we combine those assets. So we do it for fixed income, we would for forex exchange, we would do it for equities, we can do it for derivatives, commodities, all. But in this chapter, we are just concentrating on those 3 items, and then we will get here, exposure here, exposure here, exposure here, which means we will get 1 DIR here, 1 DIR here, 1 DIR here, which means in value, in dollars value, how much we are losing from the fixed income securities like bonds, how much we are losing from the foreign exchange operations and equities, and then we have to combine all of them and produce what we call portfolio aggregation, which is actually the combination of the DIRs. And this is like, a portfolio calculation of the risk portfolio. Now, this is actually when we calculate the risk matrix. So the risk matrix is computing the DIRs for each single asset inside the portfolio. And then we will have to calculate the risk matrix for all of them through this, what we call a portfolio aggregation. But this one, as I told you, have problems. So we move to something called historic OBAC simulation, which solves part of the problem, but it has also its own problems. This is statistical based, econometrics based. This is no statistics here. This is what we do simulation, which means we also solve the problem which is created by historic and provide better model called Monte Carlo simulation. Now, all of this, we'll talk about it. The regulatory model is there, but as you can see, the excess here, we are not going to cover it actually. We'll talk about it in week 11. That's all for, this is the end of this part. And I will later on, talk about part 2. Thank you for now and see you.